Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleague Nigel, and Reema is joining us today on the show as well. Good morning, guys. It's feeling more and more like the end of the year.
Yeah.
Right? Things are quietening down, not big price moves, and we're thankful for that. Let me just quickly tell you how things are looking this morning as we start another session. You've got global cues which are soft. As I said, not very much is going on. So very, very subdued. The S&P 500, it ended just about 0.19% lower. The one thing which is moving, and it's thankfully moving in the right direction, is oil prices. Although the reaction to falling oil has been, so far, it's a very short period to assess it, it's been deflationary in nature. It's not really leading to a risk on where it should lead to risk on. I'll get to that in greater detail, but oil's sold off quite a bit. The Brent oil price now at about $77. I mean, it actually almost broke that, then bounced a little bit. The big one is the 200-week moving average, which is at about $69.45. That's, about $7 away, but that's a big one to watch. That will basically confirm in a way, the end of all of those people who are still around calling for $100, a big spike, a big swing, etc. I think we should completely rest that argument once that level goes. But in any case, 77 to a dollar, great news for a big importer like India. China continues to reopen. Also, there was a Politburo meeting yesterday of the Chinese Communist Party. The top leadership met, and they're increasingly focusing on the economy once again. Things that we've not heard for the last couple of years, which is attracting more FDI flows, etc. And the reason that is important is because, just think about it. The last so many months, we've all been talking about, and guests who've come on the program have been talking about how there'll be more flows out of China into India, and etc., etc. Not just, portfolio flows, but even manufacturing moving out of China. So China is trying to do damage control, both in terms of pushing economic agenda and also faster reopening. It doesn't reintroduce a little bit more competition for flows and on the economy side as well. That's the question which I think we'll discuss. The Nifty yesterday, just to come back to a couple of things, the Nifty broke the low of 18,591 yesterday, which is nothing but the lower bound of the upward sloping channel which we've been highlighting. Next level to focus on the Nifty is the 20-day moving average, which comes in at 18,460. That's a level we've highlighted many times before. Banks were much more resilient, and I guess thank you to names like Axis Bank, but more importantly to the PSU bank space, which did quite well. But it's getting more and more dispersed, more and more scattered. So tougher to kind of identify a sort of a pocket or a bucket of stocks which will continue to do very well from here on. So it's quietening down, and I think it's not necessarily a bad thing. Market's been grinding higher. Are we going to see a bit of a grind lower? That's the question. The SGX is indicating just a 12-odd point lower start. Reema, hi. Nigel, hi.
Hi. Year-end dynamics, right? But next week is a very big week because you've got the US CPI, the FOMC, and not just that. Even the ECB and the Bank of England will be holding their final policy meet. So it's a very eventful meeting because these are the most influential central bankers. So perhaps ahead of that, there is some caution which is prevailing in the global markets. But yesterday, for the US markets, pretty flat, right? Aimless, you would say. But that is not bad because in the prior 4 sessions, the S&P 500 had lost close to about 4%. So a flat session perhaps is a win for the bulls. For our own markets, what we've started seeing is that the FIs have started selling in the cash market. There have been a lot of block deals, so that also tends to, swing the kind of flows that we have. But 1,200 crores of outflows from the cash market yesterday. This is the 3rd consecutive sell figure by the FIs, and the DIIs bought less than 400 crores in the cash market. There's lots to track today. You've got the counting for Gujarat and Himachal Pradesh elections, the legislative assembly elections, which begins. It started at 8 a.m. and we will be getting you all the updates coming in from that. Weekly options expiry, and not just in, we've got a new listing as well, right? Dharamaj Crop. Small one, but it saw pretty good subscription, 35.5 times. So we'll be watching out for that as well.
Well, Reema, for me, 3 big cues. The institutional flows, they have been waning a little bit. The second factor is both the Nifty and the Nifty Bank, they have the 20 DMA in sight, which is a very, very crucial support. That's the near-term support. And the third factor is the PCR has cooled off. Let's address all these 3 points. First up, in terms of institutional flows, well, yesterday we saw outflows to the tune of around 850 crores. I look at the FI and the DI numbers together. We have had 5 sessions in December so far, and the FIs have bought only 1 out of those 5 sessions. So they've sold close on 4,500 crores. That's another important point. On the FI action in the F&O market, well, index futures, they added some shorts. They added close on 7,000 short contracts. On the flip side, they unwound some longs as well. And on the option side, they bought calls, but more importantly, they wrote calls. And they wrote calls rather aggressively, telling you at higher levels we like to see some bit of supply. Now, in the positioning on the index futures first up itself, the long positioning was at around 77% at the start of the series. It's come down to around 61%. And the net long positioning, it was the highest we have ever seen, close to around 90,000 contracts. That's come down by a third to around 30,000 contracts odd. Short point is there are shorts in the system right now. If they don't get followed through, you'll get a bit of a short covering bounce. That's the hope from the bullish argument. On the option side, remember today we have expiry that will play out. So crucial to look at the near-term contracts as well. The calls were written very aggressively. 18,800, 18,700, 18,600 call. All those 3 strikes put it together. We should get that plate up for you on the screen. Close to around 1 crore shares were added. So call writing is very, very aggressive. And that explains why the PCR has cooled off to around 0.75 from around 1.5, which it was just around 10 sessions or so ago. So it's at the lower end. Remember, at around 0.65, 0.7, we see a bit of a bounce on the Nifty itself. So what are the levels you're tracking? Resistance will come in at around 18,675. I say this because we're seeing writing at around that 18,600 call. Support, though, is there at around 18,475. And that's because the 18,500 put saw a fair bit of open interest. The premium out there is around 25 rupees. So that's the broad range that you're looking at today. The 20 DMA, very crucial for both the indices, Nifty and Nifty Bank. A bit of a dip, my guess is, gets bought into at some point of time. We have a couple of big queues, but the last sort of trade will belong to the option traders because the expiry will play out. What else, Rima?
Interesting. Let's, what else? Important opinion coming in from a wise men. This is on equities. Chetan Seth of Nomura expects a far better 2023 driven by China's reopening or recovery as the Fed's tightening cycle approaches the end. He says while they expect Q1 2023 to be choppy due to weak US-China data and the Fed's late cycle hikes, they think Asian investors should use this volatility as an opportunity to raise exposure. He says recessions in US and Europe in 2023 mean a growing Asia will likely be the outperformer, with softer US dollar the additional kicker. He says Asian stocks have local catalysts, valuation support and a better fundamental outlook, while investor positioning is light and balance sheets are strong.
Well, let's get you some money market views as well. Parul Mittal Sinha of Standard Chartered Bank says the dollar INR is facing upward pressure despite weak dollar and drop in oil prices on strong importer demand and possible outflow, she says. Forwards dropped last week in response to the dollar shortage, while RBI clarified it is temporary. She expects the dollar INR pair to trade in a range of 82 to 83 to a dollar next week.
On the bonds, Parul says domestic yields saw some upward pressure on repricing of rate hikes post a more hawkish MPC decision and guidance. She says the rally in global rates had a salutary effect. She expects the 10-year benchmark bond yield to trade in a range of 7.25 to 7.4% next week, with a close watch on the FOMC along with India and US November CPI data seen cooling to 6.35 and 7.3% respectively.
Well, we have a lot of stock-specific action to track for you today, and we'll get to that in just a bit in our special Top 10 segment. We're looking at macro